Hello, everyone, and welcome back to the J22 Report. I'm your host, Johnnie Market, and I just wanted to get into a quick video again. I just want to I've gotten a lot more subscribers. My last video seemed to be a hit, so thank you all for watching it. Hit that like button and subscribe if you already haven't. So, welcome back. I do the best I can to inform and talk to people about, what's going on and everything. And I just wanted to harp back on to a video I did a couple of days ago. And I talked about when I think the government will admit to recession. And I think it's when tax revenues start to decline. And I just pulled these, and I pulled these from the most cheerleading sections. I didn't pull these, I don't even believe the numbers are fully accurate, but this is from the White House. So if I looked at federal income taxes, they decreased by 457 billion and 9.3% in 2023. The main reason is capital realization gains fell. And I would attribute that because they collect, from the year 2022. I would contribute that to the crash in the bond market. Because a lot of people own bonds, they own treasuries, they own yielding debt, and so they probably took a haircut on a lot of their bonds. So I would say that I would attribute probably that to that. I don't remember the stock market doing horribly in 2022. And then the other one is 106 billion lower deposits of earnings from the Federal Reserve. So the Federal Reserve is in trouble too, which is very interesting. They have the power to print money and lend it out. So maybe they own a lot of bonds. So that would actually make sense because of their quantitative easing programs and everything. They buy bonds. So if the bond market declines, so does the Fed. And then here's the other thing I just pulled out. Net decrease in receipts was the net effect of lower than estimated collections of corporate income taxes, social insurance and retirement receipts, excise taxes, individual income taxes, and nearly all other sources of receipts. So that just shows that in 2022, the economy was beginning to decline anyway. It wasn't just capital gains. Collections of corporate income taxes. Now, there are corporations do buy and sell stocks of other companies, and they could write down, they have to unrealized loss, unrealized gain. So there are, but retirement receipts, excise taxes come from alcohol and stuff. So that's the spending less. And then all other sources of receipts. So it wasn't slowly. So you can see the real economy is declining. It's not yet in recession, but I'm going to post that article below. And they even said fell due to higher interest rates. So the White House blamed lower tax receipts on higher interest rates. So behind the scenes, they're probably pushing the Fed to lower interest rates, and I think that's why the Fed has said it's going to pivot. The only problem is now with inflation going up. Yeah, that's a big problem. So, and then one thing I like to do, we do this in accounting. I'm an accountant by trade. Take one account, check it with others, make sure everything's correct. All counts. So I looked at state taxes. Now, federal taxes, they declined by 9.3%. State taxes, overall state tax revenues declined by 5.3%. Now, I was looking at income taxes. Now, I did this on my phone, but only 14 states collect capital gains. And I don't think it's as part of a big of a budget as is federally. So the decline for most of this was driven by declines in personal and corporate tax revenues, while sales tax revenues increased, and they even say in nominal terms. They didn't say in real terms, they said nominal terms. And states are continuing to feel the impact of high inflation, volatility in the stock market, and oil prices. Now, 2022, oil prices were very strong. And states like Texas and Alaska, they would benefit, as well as the shift in federal monetary policy and changes in consumer spending. But due to differences in states' economic conditions, employment rates, industry compensations, tax structures, these macroeconomic factors are affecting states differently. Which that would make sense because you see a lot of people moving away from California, New York, and they're coming into Florida and others. But here's the other ones. Strong rainy day funds help states pass their fiscal 2024 business budgets without too much drama. And about half the states updated their fiscal revenue forecast, anticipating a slowdown, another slowdown. Now, here's the thing. This is why the Fed will pivot. You have to remember the states are projecting another slowdown in revenue. And, you have to remember unemployment. That's paid out by the states. So if there was really a strong economy, like they say, the state tax revenue, they wouldn't need such a good rainy day fund. Because remember, the unemployment, that's a lot of it. So projected revenue, negative 1% for the fiscal year. And then it has total state revenue forecasts. And this has like the states that go up and more. It's a tax policy center. Of course, Oregon is supposed to really decline. Oklahoma, Illinois, ones that have to increase. Virginia, of course, that's in DC, government contracting. No, Massachusetts is supposed to increase too. Maryland, that's another one. DC, government contracting. Kentucky, which, that's supposed to. Florida's supposed to decrease. That could be lower taxes, but state personal income taxes and revenue projected to decline 2%. 2024, weaker than personal income tax revenue. Now, state tax revenue forecast. So they blame these on income tax rates, pass-through entity taxes that have led to weaker personal income. So, I mean, and, they're also saying it in bracket creep because, inflation's going to have people in higher brackets. So, I don't know exactly what's... but I don't know exactly everything, but this is not looking good. Revenues are falling. They look like to fall in 2024, not just federally, but locally. And this is why, and they both, looking at the White House, they literally blamed it on higher interest rates. And state taxes, they blamed it on Tax Policy Center. They blamed it on inflation and higher tax rates. And the other thing is, another reason I see is, I talked about bankruptcies. Bankruptcies filed surged by, I found an article, 18% in 2023 on the back of higher interest rates and tough lending standards. And yada, yada, yada. I'm looking at it. Chapter 11 filings shot up by 72%. And then bankruptcies are expected to keep climbing in 2024, even though there's still some distance to go to top. the 816,000 bankruptcies files in 2019. But the thing is, as bankruptcies keep climbing and climbing with higher rates, this will lead, and tax revenues are falling, that will force the Fed to have to admit recession. And the other thing is, once things get going, there's a waterfall effect, and that will continue. So I'm going to post these 3 articles below, and I'm going to get into 2 other things. One, tech executives are telling investors they have to spend AI to make money. A lot of money's flowing into AI. Hot money's has flown into AI. And if you look at it, that is the definition of a bubble, where a lot of hot money and whatnot, just speculative money, runs amok. I looked at a chart in a video, it's just a beeline up. It was literally a couple years ago. I saw it in 2019, it was like $3. It was something ridiculous. And one thing that encouraged me, I'm going to go to gold now, is that Stanley Drunckenmiller, I forgot about this, but he bets on the 2 world's largest producers. He has dumped his Google, Alibaba, and Amazon in the 4th quarter of 2023. And he has bought shares of Barrick and Newmont Mining. 1.7 million 6 shares of Barrick and 474,000 of Newmont. And increased his exposure to tech resources. So I have to be honest, this is why a lot of these people, Warren Buffett bought Barrick, a lot of these professionals don't know resource investing. I've done it since basically 2009. I've done well. Despite the Huey falling 50%, I'm still up in my portfolio, doing pretty well. So that's the one thing I know. And if I was buying a lot of seniors, I own this one, Anglo Eagle. This is not investment advice, just my opinion. But investing in resources is different than investing in tech or Clorox or whatnot, because your assets deplete. And it's a lot about smart capital allocation. It's about patience. That's what investing is. And this is what a lot of people don't know. You have never been into the lion's den until you've been in the gold market. My friend Rahul from AIH can back me up on this one. And my friend Jordan Royburn, Daily Gold. Great video. If you've never been there, go there and subscribe, support him. He has a great newsletter. If you're a beginner in gold, go over there, subscribe to his newsletter. He would love to have you, I'm sure. Anyway, he can probably back me up on that. This is the lion's den. You're a man's man if you've been in this market, and I can honestly say that. And this is market, in my opinion, Drunckenmiller, I think he's going to do well. Good timing. I just think, Franco-Nevada, royalty and streaming. I think Anglo Eagle Mines. I think they're better buys than Barrick and Newmont in the senior. I can't think of all of them off the top of my head, but this is one company can go from crap to being amazing in this business. And so that's the beauty. So anyway, that's all I have to say is that, the smart money, Stanley Drunckenmiller, they're getting into this sector. And tax receipts are declining, not just at the federal level, but the state income. And the state income taxes, they're not declining as much as the federal because they're not as dependent on capital gains, but it shows that the real economy is also declining in the bankruptcies. So this will force the Fed pivot regardless of the government numbers. And this is the type of in and out research I do. Check, verify multiple sources before I jump to conclusions. So if you like this video, hit that like button, subscribe if you already haven't, and I hope to see you next video.